Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
We want to start off by saying Merry Christmas.
Merry Christmas!
This is our Christmas episode. We have our red shirts on.
We're very festive.
We wore this exact combination about a week ago, I think.
I don't know.
Very festive. We normally don't reuse like the exact same combinations. We go back and look at videos and make sure we're not wearing the exact same thing. But I don't have an unlimited number of clothes to just put on.
Neither do I.
It's certainly not unlimited.
But if we can get to 100,000 subscribers, we will have a more robust wardrobe.
Yeah, we'll be able to afford some. We have a wardrobe director who purchases all our wardrobe, and we'll be able to hire another person for the staff to find us more clothes to wear. Okay, we are going to talk about real estate.
Yes.
Well, this is interesting. This is from Fitch ratings. They say U.S. homes are overvalued by nearly 10%, but homebuyers shouldn't expect relief anytime soon. I thought that's pretty interesting. In economic terms, if you are overvalued, you are technically not in, you are in something called disequilibrium. You're not in equilibrium, right?
Right.
So if you are in disequilibrium, a marketplace will try to reach equilibrium, but now they're saying homebuyers shouldn't expect relief anytime soon.
Right.
What is overvalued? Like, what does that even mean?
Well, so that's really kind of puzzling right now because we are currently in an environment where we have more buyers than we have sellers. We have a low number of transactions when we're looking at historical numbers. So the value of the homes is probably pretty reasonable. Considering the present situation, we still have multiple offers. And this is an environment where all of 2023 has had higher interest rates than what people would like. They've been closer to the long-term average, but everybody has behaved as though the sky was falling.
Here's the first quote from the article. Even as the average 30-year fixed mortgage rate briefly topped 8% this year, U.S. home prices surged 6.7% between January and September, according to the Case-Shiller U.S. National Home Price Index. And data from NAR shows that median existing home prices for all types of housing jumped for the fifth consecutive month in November, rising 4% from a year ago to $387,600.
There you go.
That's a pretty big jump, right?
Yep. So that doesn't look like a market that is rising extremely rapidly, but it is rising and it is very robust, but it's, we're not looking at 28% increases in value in a year like we've seen. So that kind of lets us know that maybe that overvalued thing, it's a little questionable.
Okay. So they start off the article, Fitch Ratings, by saying home prices are overvalued. And here's the quote from the article. Fitch Ratings also expects national home prices to rise as much as 3% next year, another 2 to 4% in 2025. This will continue to impact affordability, particularly for entry-level and first-time homebuyers, thereby constraining demand, the agency wrote in its Wednesday report. Historically, people sold their house and bought another one. When the pandemic came and we had the highest number of refis we've ever had, where people locked in super low rates, that took out a lot of incentive for people to sell homes.
It did. I kind of want to go back to this quote that you just had, that they're expecting home values to go up 3% in 2024, and 2% in 2025.
2 to 4%.
I'm sorry, 2 to 4% in 2025. That wouldn't even keep up with inflation. So I kind of question that.
Okay. Fitch found that price increases in high mortgage rates left U.S. homes overvalued in 88% of the country's metropolitan statistical areas, which are cities, okay, they're suburbs, right, in the second quarter. And more than half of these were overvalued by 10% or more. The top three, they're not major cities like New York City or L.A., but Charleston, South Carolina, El Paso, Texas, and Camden, New Jersey. Whatever. Okay. Not interesting. Okay, there's another quote in here I want to get to because I think it's really the best thing.
Okay.
Oh, no, it's this quote. Juana, this is how the quote starts out. Fitch found that price increases and high mortgage rates left U.S. home prices. So I'm betting when they did their research, the mortgage rates were close to 8%.
Right. But, they just have this a whole mindset that everybody is getting these maxed out loans with no money down and nobody's paying cash, and somehow they're conflating affordability with value and with all these other things, and I
Right.
think that's really sad for somebody in their position.
I agree. This idea that all a house is worth is what some random person's job income is completely fake. Because what if I want to buy a ski chalet at Tahoe? Hey, I only make $40,000 a year, and I would like to buy your chalet. So, at the current rates, I can only afford $2,000 a month. So you have to drop the price of your chalet from $5 million down to $350,000, so I can afford it. Because that's all it's worth to me, right?
Right.
And then some guy walks in with cash and goes, "Oh yeah, $5 million, I'll take that."
Right.
That sounds like a deal, right? Okay, here is another take from NAR. Home prices keep marching higher. NAR's chief economist Lawrence Judd said in a statement, arguing that only a dramatic rise in supply will dampen price appreciation.
Well, okay, I will agree that dramatic rise in supply will dampen price appreciation. Okay, that I will agree to that, providing that dramatic rise in supply is not met by a dramatic rise in buyers. So, because if supply and demand are in an equilibrium, then that's not going to result in loss of value.
Right.
So, again, they're not telling the whole story.
Okay, here's another good one. I really like this one. Rising U.S. home prices and higher mortgage rates have combined to destroy home affordability over the past few years. There's that higher mortgage rates again. In October, Americans' average monthly mortgage payment climbed 10.6% from a year ago to $2,259 according to NAR. That's compared to America.
So that's for people getting new mortgages, not for people with existing mortgages. So this is one of my pet peeves when they say that somehow, people with mortgages, their mortgages climbed by 10%. No, they didn't. It was only new mortgages, not existing mortgages.
Okay.
Sorry, continue.
No. Remember, in a given month, only about 0.2% of all people buy a house in a month, right? So only 0.2% of the people are paying this 10% more than they were a year ago. Everyone else is paying the exact same thing. Actually, every single other person is paying less than they were a year ago. Why is that, Juana?
Well, they're paying
in real dollars.
They're paying less than a year ago because their wages have gone up.
Ah, inflation.
Yeah.
So that $1,500 a month mortgage payment, you just got a 3% pay raise for the year. You're not paying 10% more on your mortgage. Or this is ridiculous. Here's the other ridiculous thing about this. Let's say, and it says in October, mortgage rates were 8%. These people probably today could just refi the thing and be back to normal. And if rates drop below 5%, they're all going to refi.
Oh, yeah.
So this whole thing that, like, in theory, so if you paid $400,000 for a house at 8% rate, does that mean that if rates drop to 4%, you could get $800,000 for the house because rates have gone in half, therefore your house is worth twice as much?
No.
No, it doesn't work that way. Okay, here is another quote. And with mortgage rates still above 6.5% compared to just 3% in January 22. Oh my God, I knew it. This 3% was going to be like, but 3%, that's the going. Remember we had somebody come on the channel like a year ago and said, but Todd, interest rates have always been 3%. They've always been 3%. Okay. NAR's housing affordability index has fallen to just 91.4. That's not great news considering any level below 100 means the average U.S. family cannot afford a median price home. Only about 3% of all people will buy a home in a given year. Because it's not even that. We have 300 and something million Americans. We sell about 4 million houses a year. So it's like a couple percent, maybe 2% of people will buy a house in a year. Okay, if all of the average people in the U.S. and above, 160 million people, decided to run out and buy a house, there's only 3, 4, or 5 million houses that sell every year. So it's not like they could all run out and buy. There's not enough. So this idea that, oh my gosh, the average person can't go buy a house. Well, they can if they put more money down.
Look, if 150 million Americans were trying to buy 4 million homes, what do you think that would do to home values?
Yeah. It'd be pretty crazy.
Yeah.
Here's another pretty cool quote. The U.S. has faced a serious housing shortage for years, with experts estimating the market needs between 2.1 million and 6 million additional units. Most Americans can't afford the typical house, according to the National Association of Realtors Affordability Index. But the minority who can face slim pickings in the existing home market, Bill Adams, chief economist for Comerica Bank, said Tuesday.
So a couple things there. First of all, when you say most Americans, so let's hit that like 160, 180 million Americans, however many that people. Okay, but a lot of those are already homeowners, so they don't need to afford a new one. They're good and happy where they are.
Right.
A lot of those are maybe tenants. There are all kinds of people in that group. So the idea that somehow, again, over 160 million Americans are trying to buy 4 million homes in any given year is not reasonable.
Here's a funny thing. I was talking to a guy that is in startup world in the Bay Area, and he bought a house in 2009 in the Bay Area. And what he said was, I couldn't afford the house today if I wanted to buy it. Mm-hmm. But remember, he's already got the house. Mm-hmm. So the idea that his house is unaffordable, it's not unaffordable for him. He mm-hmm. bought it at a lower price. He has a very low interest rate. It's affordable for him. Mm-hmm. And he's probably not going to sell it.
Right.
And if he does decide to sell it, well, then someone who can afford it will have to buy it.
Right.
But this thing about, my mother, when she passed away, could not have afforded the house because she only basically had Social Security.
Right.
But it didn't matter because she'd owned the house. Mm-hmm. So this idea that, I couldn't afford the house now, it's unaffordable for me at my current wage, is kind of a red herring, right?
Right, it is. And look, we're not saying that all homes go up in value, okay? So please understand that not all homes go up in value. We've seen homes in parts of the country where we would have thought that homes would have gone up in value, and they didn't. And maybe they didn't go up in value for many, many years. So this is not for everybody. Remember, real estate is hyper-local, so look at your local market. What's happening there? We're not suggesting that this is a formula that can be blanket applied throughout the country.
Right. I actually looked at a house that I bought in Illinois on a lake, and we were guessing what it's worth now. And of course, we were using like West Coast appreciation numbers mm-hmm. for how much this thing would be. And what we found was basically worth barely any more. And this was a house that I bought 23 years ago. Mm-hmm. So a house on a lake purchased 23 years ago is basically worth, it hasn't even kept up with inflation, not even close.
Right.
It's actually worth less than the inflated value.
Right. So do pay attention to what's happening in your market and understand that. Seek advice from a real estate professional, because they'll be able to guide you and help you understand what's happening in your market.
Okay, last quote from the article. However, Capital Economics Ryan warned that he still expects inventory to remain extremely tight, even if mortgage rates continue to fall next year. This is that effect, Juana, we talked about, mm-hmm. where people aren't just going to magically give up their 3% rate because they can get a 5% mortgage. They're still probably going to say, okay, I'll go buy the other house, but I'm keeping this 3% mortgage, right?
Right, because the people don't necessarily need the money from their current house, and they want to protect that mortgage because they figured out that it's a good investment.
And Jefferies senior economist Thomas Simons cautioned in a note this week that although the recent data from home builders is certainly encouraging mm-hmm. and suggests that a chronically undersupplied market's about to find some relief, we're skeptical that we'll see this strength persist. Now, this data they're talking about, the home builder number, the new home permits are up, but they're up like 12%. But remember, they're off 12% from historically low number of homes being built. And it's still below the number that we need built to make to break this 2 to 6 million. Like it's literally like 100,000 more homes in a year than built than the previous year. It's not very many.
Right. So the housing shortage, it's not ending anytime soon, even with the new homes that are being built. And as far as sellers coming on the market, some homes absolutely will come on the market. More than this year, probably. Enough to satisfy the demand? Probably not.
Right.
All right. what's going on in your market, since we brought up several different markets.
Oh, what did you get for Christmas?
Oh, yeah.
Did you buy a house?
Right. So what did you get for Christmas? Were you good? Hopefully you didn't get a lump of coal. Leave us your real estate related comments and what you got for Christmas in the comments. We appreciate you watching. Please remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.